three chapters if you look at the investment environment, asset classes and financial instruments, how securities are traded. To some extent we have already discussed this, what is Bombay Stock Exchange, what is National Stock Exchange, the Sensex, Nifty, right? So what do you mean by market capitalization of a company? All these are bonds versus equity. These are all topics which you can develop over the period of time by browsing the net, speaking to your friends and other things. Okay, so getting a general view about the market is very easy, and most of them would have done that, right? So because of your investment plan, you would have spoken to some of the LIC agents or any of the mutual fund agents. So in this process you would have already developed a brief idea about what is market and how it works. The fifth chapter, which they provide risk, return and historical record, right? There is a very particular way of calculating securities risk and return. How much risk I am taking by investing in this stock and how much returns I am getting out of it. In the same way, more than one stock if I invest, that is called as portfolio. People always speak about portfolio managers, right? So it is nothing but more than a stock means it is a portfolio. So what is my portfolio level risk I am taking? What is my portfolio level returns I am getting? Okay, so that is we have to learn. We have already learned basic statistics like mean, standard deviation, correlation, covariance. With the help of it, it is just like quick run through. Okay, because everything again comes through is statistics here. Okay. The CAPM model, the ninth chapter which they have provided, the capital asset pricing model, is a celebrated model in finance. Nobel Award winning model. It's 1991. William Sharp, by name a person who is a student of Harry Markowitz. They both shared the Nobel Award in 1991. So that model we are going to discuss in chapter 9. Okay. So you should be knowing Nobel Award is like nothing specific to any one field. Once the usage becomes very broad and very generic, those theories will get Nobel Award. Right. The usage should be very vast and it should be original. In nature, such particular theories will get Nobel Award. Right? So the theory might have started in finance, but it might start getting used in strategies. It might start getting in. They might have formed in equity market, but it might start getting into derivatives market, bond market. Once that field gets just expanded, that is the model which will get Nobel Award generally. Okay. So that is a celebrated model in finance. It solves multiple problems in finance like project management related issues. Then cost of equity, like how much equity shareholders as the owners of the company should expect from the company, right? And what is the opportunity cost when I am investing something, right? All those particular problems will be solved with the help of this capital asset pricing model. Okay. So the next theory which we are seeing is arbitrage pricing theory, which nowadays is becoming more popular, right? It is becoming a competitive theory for capital asset pricing model, right? So two persons by name Lubin, Pharma and French. Pharma and French model is called as, it's a three-factor model which is becoming more and more popular nowadays, right? I have worked with most of the hedge fund managers, portfolio managers, right? Till 2009, 2010, a lot of people used to ask me about CAPM model. Nowadays they are asking, can you also provide arbitrage pricing model, especially Pharma and French model. That is the development happening, but still 90% of industry is using CAPM model, capital asset pricing model. Okay. So the efficient market hypothesis theory, the 11th chapter, is such an important theory, right? It is expanded even into a currency market, government reserves which they have to follow, right? So why prices changes every day is a question, right? Demand and supply is the answer which we get. 1971 onwards, we are following a flexible exchange rate system in the international markets. Dollars, euro, yen, pound, all these changes every minute. Prior to that, it was more or like fixed. 1870, to 1930, prices never used to change. It was called as gold standard system. For 40, 50 years, prices never changed. But now we are in a stage where every minute price changes, right? So what drives that price changes, right? So demand and supply is a basic principle in economics which changes the prices, but are they efficient? Like what is perfect market theory in economics, in finance it is called as efficient market hypothesis theory. So that is once again a phenomenal theory which brought in 1950s, which made markets as modern portfolio theory. Today whatever we are learning called as modern portfolio theory, that came up because of this efficient market hypothesis theory, right? So chapter 18 speaks about how to price an equity share. Currently, let's say a share is trading at 800 rupees. Is it worth paying 800 rupees? Or is that stock worth more than 800 rupees? Or is that stock worth lesser than 800 rupees? What is its intrinsic value? What is its actual worth? Is it overvalued or is it undervalued? To find out that, you may have to literally value a share. So that is equity valuation methods in 18th chapter we discuss. Then to understand the company's performance, we use couple of ratios, okay, and key performance indicators, KPIs. So those will be learned in 19th chapter, financial statement analysis. And at the end, 24th chapter speaks about portfolio as a whole. If I have multiple stocks in my bucket portfolio, one stock goes up, one stock comes down, but at the overall level, what is my portfolio doing? I have invested 50,000 in one stock, 1 lakh in another stock. I am not now worried about 50,000 and 1 lakh, I am worried about 1,50,000 as a whole. How my 1,50,000 is performing. Let one stock come down. If the other stock goes up better than the first stock, then I am happy with that. So that is one thing I am looking at. So portfolio level analysis. So these are the chapters which I take up, right? So today we will discuss, first half an hour we will discuss about basics about markets. Then we will quickly move on to risk and return chapter, right? That is the first level where we will take a security, understand how much returns I am getting from that security, how much risk I am taking because of that security. Risk and return is like a two sides of a coin. If someone promises me I will give you 50% return in 1 month, there should be some associated risk involved in it, right? Chit fund business might give you more returns than a State Bank of India fixed deposit, but State Bank of India fixed deposit doesn't carry as much risk as the chit business carries. So risk and return has to be evaluated always together, hand in hand. Otherwise we will end up in a loss, right? So for the risk I am taking, am I compensated enough, right? So that is very, very important, right? So we'll look into it quickly. We'll start discussing basics about the markets.
Sir, how this book is different from Sundar Pandyan book?
Sundar Pandyan and Azal book gives about generally about statistics. It is not specific to finance or anything, right? This is completely about markets, stock markets. Okay.
2 weeks back when I had discussed it,
Exactly.
I already ordered that book.
Good. That is like generic. Once you read that book, you can start thinking in any areas, any functional areas, right? So that is the basics. As I said today, average, standard deviation, all those things comes from that book, right? Perfect. Right question.